In the world of investment and trading, NASDAQ has always been emerging head and shoulders above all the other exchanges, especially for retail traders looking for growth opportunities. The potentials for disrupting technologies that may redefine entire sectors has always existed there, along with the possibility for the corresponding exponential growth in the share price. Many titles have begun their adventures here in order to become the titans of tomorrow. It's normal for traders, therefore, to also navigate those exciting and yet volatile waters of NASDAQ in order to identify a precise way to capitalize on the defining enterprises of tomorrow. It is, after all, one of the birthplaces of the modern economy based on the connectivity, speed, and analysis using the tools and technology of a new era. Amongst all the titles that may bring us wealth and prosperity, there is Palantir, the data analytics firm based in Denver, Colorado. Palantir has been an enigmatic company ever since it went public on the NASDAQ, and I would say even before so, when it was seed funded by the CIA, with a reputation shrouded in controversies and mysteries. As a data aggregator and analysis platform, it has one of the deepest relationship pools with the public sector entities for large contracts in healthcare, defense, and intelligence gathering. Its price action is directly linked with the company's own fundamentals and also the wider risk appetite of the market. And with an increasing institutional participation in the company, there may be a lot more potentials to where the share price might go to. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and to subscribe to my channel. In recent market movements, Palantir has steadied around $16.25 mark, showing a slight dip of approximately 7% in the past 5 days and a more pronounced 11% decline over the past month. While these short-term shifts may not carry overwhelming significance in the grand scheme of things, factors beyond fundamental considerations may contribute to those fluctuations. The current market climate is characterized by fewer traders and still reduced news circulation, creating a relatively subdued atmosphere. Despite these conditions, Palantir maintains an overall bullish trend, showcasing commendable performance throughout the year. The prevailing sentiment on the street is favorable towards Palantir, acknowledging it as a noteworthy company with compelling technology crucial to various businesses, especially in the public sector. However, a notable concern has always been Palantir's considerable dependence on the same public sector, leading to a somewhat top-heavy and less diversified stakeholder structure. Despite being a known aspect of Palantir's business model, this dynamic likely has influenced its current pricing. Looking ahead to the upcoming year, potential challenges may surface from the broader market. As Palantir's clients primarily operate with the real economy, potential budget cuts for individual-level research and analysis could be problematic. Nonetheless, Palantir has demonstrated its ability not only to turn profits and maintain cash flow self-sufficiency, but also to navigate the evolving trends such as the artificial intelligence and large language models. The fundamental profitability of those ventures remain uncertain, of course, but Palantir has unquestionably gained momentum in the market thanks to them. As we continue to navigate the dynamic landscape in 2024, it's crucial to observe how Palantir adapts and capitalizes on the emerging markets. With that being said, here are the technicals. The trading volume of Palantir recently ticked around 40 million shares compared to the average volume of 51 million shares. Over the previous 52 weeks period, the price fluctuated between $5.84 and $21.85. The volume of shares traded now tells us how many shares are being bought and sold at any given point in time, and if there's enough liquidity to support a trading strategy. If the float is too thin, it would be very easy to influence the stock price, but low liquidity could mean that the demand is limited too. When we compare the current price against the average volume, there might be the possibility for trend reversal or breakthrough if the difference is too large. For instance, if the stock were to break through, the current volume would be significantly higher than the average volume. The market cap for Palantir is currently around $35 billion compared to the enterprise value of $15 billion. As we compare the current market price to the historical price fluctuations, the stock is 2% higher than the 1-month low, 12% higher than the 3-month low, and 187% higher than the 52-week low. As for the options, which often gives us a hint about where the market sentiment ticks towards, the implied volatility is currently 51%, compared to a historical volatility of 47%. The put-call volume ratio is currently at around 53%. It is normal for many stocks to have a higher put option volume than what they deserve because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is around 221,000 contracts a day versus the 30-day average of 275,000. Regarding open interest, the most recent volume of open interest is around 3.1 million contracts compared to the 30-day average of 3 million contracts. In terms of the shareholder structure, institutional shareholders own 40% of the current float. The biggest shareholders include Vanguard, Renaissance, and BlackRock. It's always encouraging to see institutional participation when holding a stock long-term because they offer layers of stability and token of reliability in the medium to long term. Their presence suggests that the market believes that they will deliver value for their investors, which is an important factor to consider for investment beyond trading. I personally believe that a minimum threshold should be around 25 to 30% for institutional ownership. But there are many exceptions to this rule, of course. But in this case, let's just say that it's encouraging to see 40% of the float in the hand of institutions. The current short interest is around 6% of the total float, 53% of the transactions from the dark pools. Typically, if the short interest is above 15% of the total volume and that a significant portion of the shorts come from the dark pools, it could suggest institutional participation in a short operation and that there would be potential for short squeeze. Of course, at 6%, I wouldn't say that Palantir is really ripe for any sort of short squeeze, let alone the fundamentals don't really suggest any sort of structure. Of course, analyzing securities from a fundamental perspective is always helpful, but it should be complemented with extra external forces at play. Investing in the stock market can sometimes feel like riding a roller coaster with its many ups and downs. This roller coaster may seem arbitrary if we compare the company's operational reports and its share price action. It is profoundly influenced by real-world uncertainties, central bank decisions, and many other intricacies between the real economy and the stock market. Even if the end result may differ from their participants, the stock market is deeply intertwined with the pulse of the world, and real-world uncertainties can significantly alter and affect its delicate balance. Events like elections and geopolitical tensions can often trigger fluctuations, leaving investors and citizens around the world alike on the edge of their seats. The mere speculation of a change in political leadership or a brewing conflict can cause stocks to sway, let alone when those speculations turn into the grim, dark reality. If the recent events have shown us anything from an economic perspective, it's quite obvious that the market participants will show less reassurance in the state of the local economy and the stability of our societies. Additionally, we must face the fact that the looming risks of a recession may cast a shadow on the market. When economic indicators hint at a potential downturn, investors may become jittery, leading to heightened volatility. It is crucial to understand that the stock market isn't solely driven by the cold, hard numbers, but also human emotions and perceptions that play a significant role in shaping the market dynamics. We can actually argue that our collective and subjective perception of the future is more important than the objective facts, and that our personal impression from the immediate surrounding can affect our perception of events that happen very far away. And within these immediate surroundings is the central bank, a key player in the financial orchestra. The interest rates set by the central banks have a profound impact on the stock market's rhythm, especially for exchanges like NASDAQ, where the tech companies often dance to a different tone. When the interest rates rise, the borrowing becomes more expensive, affecting the profitability of those companies. For the more speculative tech companies that often operate on the thinner profit margins, or in fact, negative profit margins, higher interest rates can be particularly challenging. Investors may reevaluate the risk associated with those companies, leading to sell-offs and increased market volatility. Conversely, the lower interest rates can create an environment conducive to borrowing and investing, potentially boosting the stock prices. One perplexing aspect of the stock market is its ability to march to its own beat, seemingly detached from the real economy. While the economic indicators may point to a struggling or booming economy, the stock market may tell a very different story. This divergence becomes particularly apparent during periods when the real economy is faltering, yet the stock prices continue to rise. This phenomenon can be attributed to a variety of factors. Central banks' interventions, government stimulus packages, and investors' expectations can all contribute to this disconnection. It's essential for investors to recognize the fact that the stock market is not a perfect reflection of the real economy. It is rather a complex system influenced by a multitude of variables. When managing all these complexities, investors are wise to exercise vigilance and to broaden their perspective. Looking beyond the fundamentals of individual stocks, it becomes crucial to consider the macroeconomic and monetary landscape. Understanding how global events, central bank policies, and economic indicators interact can provide a more comprehensive view of the investment landscape. Macroeconomic factors like the inflation rates, the employment numbers, and trade balances should be on the investor's radar as well. Likewise, when keeping an eye on the central bank communications and policy decisions, they can offer insights into the direction of the interest rates and the overall market sentiment. Above these elements, that are all individually important to consider, there is also another one: the idea or the concept of cyclic movement. It is one thing to assume that things will always come and go, the good like the bad, but it's quite another to assume that the next cycle will look exactly like this one. The current market may be towards the end of a super cycle that began with the collapse of the 2008 real estate market and the quantitative easing that followed. A massive amount of capital has been injected in the market for more than a decade, and this has played a significant part in the recovery and later the takeoff of the asset prices. These policies may not come back, and there may not be the same kind of recovery that we have enjoyed after the last market collapse. The past doesn't guarantee the future, and it is no different this time. So really, the stock market is a dynamic and intricate ecosystem influenced by an array of factors. Real-world uncertainties, central bank decisions, often arcane relationships between the market and the real economy all make up to what we see on the stock market. In this ever-changing landscape, investors should be well served by adopting a holistic approach that considers both fundamental analysis and macroeconomic perspectives. By staying vigilant and embracing a multifaceted view, investors can navigate the stock market with a far better understanding of the forces at play. Overall, I hold the view that Palantir will maintain its relevance in the years ahead, notwithstanding the current erratic volatilities the stock is experiencing due to arbitrary circumstances. Therefore, it seems reasonable to gradually build a position over time, disregarding short-term price fluctuations. This strategy implies an assumption that the portfolio aligns with the appropriate risk appetite for technology stocks. I would recommend to commit between 3 to 5% of your portfolio in Palantir and to split the allocation in batches of 20% over the next 6 months to purchase more in case of further retracements.